Hi guys, very good evening. Can you all hear me? Can you all see me? Are we clear? Are we clear? Can you hear me? Okay. Well, you can't hear me, is it? Hi, sir. You're clear. Okay, thanks, Harisneha. You okay, Harisneha? Been a while, isn't it?
You're welcome.
Okay. I'm okay. Bit tired, but excited to meet you all. Anyway, coming back. Hi guys, let me welcome you to another session of our revision. Um, but I think today will be officially my last revision for the March exams, officially. Having said that, I want to meet you again on Monday as well. We can work on some discussions, questions, whatnot. Not a problem. Anyway, coming back, everybody, um, we anyway decided in our last meeting, that we are going to work on a consolidated income statement and a balance sheet. So there we go. We are here to work on a consolidated income statement and a balance sheet. So I'm going to pick up a question. I think I've already got a question with me. Uh, and we're going to see how to work on a consolidated income statement and balance sheet. Okay. Right. Lovely. Everybody. Um, right. There you go. A very straightforward question, nothing to worry. If you get a question like this in the exam where you've got consolidated income statement and balance sheet both, it's a bonus for you. It's very, very, very easy for you to get through a question like this. Okay. As always, nothing to worry. I'm going to tell you how we approach. The approach is going to remain the same. The requirement: prepare the consolidated statement of profit or loss for Pedentic for the year ended 30th September 2018. Prepare the consolidated statement of financial position for Pedentic as of 30th September 2018. Two requirements: income statement and balance sheet. Are we clear? Are we clear? Are we clear with the requirement? Everybody? Hello? Everybody, give me an A. Are we clear with the requirement? Right, brilliant. What I'm gonna do is last time when we met, I did the question on the real ACCA platform, right? But some of you did message, okay, fine, we understand the platform, but then again, we can't have the question from there because the copy paste option doesn't work there. So now I thought, as usual, for me to work on the Excel sheet that I normally work on, right? So there you go. Just confirm if you can see both my hold on. Please confirm if you can see both my screens together. Please confirm if you can see both my screens together. Okay. Guys, just a moment. Give me a moment. I'm getting a message saying that we've already done. Okay, fine. Guys, did we do pedantic? Did we do this question? No, right? Yeah, no. Back here in offline. Okay. Right. Uh, I've been told that we have already done pedantic. So I'm going to pick another question. So please do post star. Okay, fine. Fine. Let's see if we can do pick up post. There you go. Okay. I've been told I've already done pedantic, so I'm going to do post star. All right. Okay. I think I've highlighted it for some other batches, but that's okay. We will get going with Polestar. Okay, fine. Brilliant. So guys, we are going to look at Polestar. This question has both consolidated income statement and balance sheet. It's a very straightforward question. Once again, all questions are straightforward. So probably you must be thinking, okay, what the hell? For every question, I'm saying it's straightforward. But this is a straightforward question. Nothing to worry. Let's see how to work around. So if you go to the requirement, the requirement says prepare the consolidated statement of profit or loss for Polestar for the year ended 30th September 2013 and prepare the consolidated statement of financial position for Polestar as at 30th September 2013. So two requirements for 20 marks. Are we clear? Right. We've done questions before. It's not the first time we are looking at consolidation. We've done questions before. So I'm going to give you a few minutes so that you can refresh on your own, and then we are going to do it together. Okay. I want to give you a few minutes so that you can go through the question on your own. So it's easy for me to work through the question together. Okay. Start. Your time starts now. Go ahead. Once you're done, give me a done. Are you done? If you're done, give me a done. Everybody, if you're done, give me a done. Done, everybody? Just go through the question, that's enough for me, okay? Don't try to do anything. Just go through the question, that's enough for me. Playing with my screen, give me a moment. Right, let's get going. Right, so in the exam, as always, what I'm going to do is I'm going to leave about 50 lines. I come right to the bottom. I come here and I say workings, correct? I say workings, and working number one always will be group structure. Please don't forget that, correct? All right, now I'm going to start reading the question. Everybody, yes, give me an A. Can I start? Everybody, yes, give me an A. Everybody, I want everybody to give me an A. Fast, fast, quick, 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 quick. Right. On 1st April 2013, on 1st April 2013, your year end is 30th September 2013. 1st April 2013, 30th September 2013. Okay, what have you discovered so far? What have you discovered so far? Well done. It's a mid-year acquisition. April, May, June, July, August, September. 6 months. Superb. On 1st April 2013, Polestar acquired 75% of Southstar. Okay, you've got Polestar acquiring 75% of Southstar. So parent, subsidiary, 25%, NCI. Done. Let's go further. Southstar had been experiencing difficult trading conditions and making significant losses. So subsidiary has been making losses. I don't care. In allowing for Southstar's difficulties, Polestar made an immediate cash payment of only $1.5 per share. Okay, your examiner is talking about immediate cash payment. But before that, my steps, I've told you, take the reserves, correct? When you are taking the reserves, you are going to take retained earnings of Polestar and Southstar. And then you will take revaluation of Polestar and Southstar. Are we clear? Right. And then what you would do, you'll take the brought forward figures. Keep that in mind because I'm going to read this entire paragraph and fill my reserves, right? Working three, investment cost. They say in allowing for Southstar's difficulties, Polestar made an immediate cash payment of only 1.5 per share. So your investment cost has immediate cash payment, $1.5 per share. So technically, how many shares does our subsidiary have? Our subsidiary has 6,000 value of shares, meaning 50 cents shares. 50 cents shares means what is the number of shares? 12,000 shares, meaning equals 6,000 divided by 0.5. 12,000 shares. So 12,000 shares, you are acquiring 75%. For every share, you are going to pay 1.5. So in other words, equals 12,000 into 75% into 1.5, 13,500. Understood, everybody? Understood? Are we clear? Okay. In addition, Polestar will pay a further amount in cash on 30th September 2014 if Southstar returns to profitability by that date. So, okay, fine. Immediate cash payment. There is also deferred payment. Okay. And then they say the fair value of this contingent consideration at the date of acquisition was 1.8 million, but at 30th September 2013, in the light of continuing losses, it was valued at 1.5 million. Okay, so your fair value that you thought you will pay was 1,800, but now the year-end value has come down to 1,500. You thought you will pay 1,800, but you are going to pay 1,500. Correct? The contingent consideration has not yet been recorded by Posta. Overall, the directors expect the acquisition to be a bargain purchase, leading to negative goodwill. Okay, what your examiner is trying to say is, look, overall, it looks like we will not have a positive goodwill. Instead, we'll have a negative goodwill. Okay, first of all, what is goodwill? The premium paid over and above subsidiaries and assets. Now, net assets value is 100,000 means if you pay 150,000, that 50,000 is the premium. That becomes positive goodwill. A negative goodwill means 100,000 is the value of net assets, but you purchased it for 70,000. If you purchased it for 70,000, you purchased it at a discount. A negative goodwill happens when you purchase net assets at a discount. So if you're purchasing at a discount, listen to me very carefully. If you're purchasing at a discount, you are paying a lower price. If you're paying a lower price, it means it's a bargain purchase. When you pay a higher price, your money cash outflow is high. When you're paying a lower price, it's good for you because you're benefiting out of it. Are we clear? Are we clear? Boys, are we clear? Okay, super. I'm over here, but I've read the first paragraph, but I know there are a few things that I need to account for. I have not accounted for this. Okay, in the exam, I know I have not accounted for this, and I have to take my retained earnings figure. Okay, super. Now tell me how much is my retained earnings brought forward figure? How much is my retained earnings brought forward figure, please? Well done. 28,500 and 12,000. 28,500 and 12,000. Clear? Right. Do I have any revaluation? Nothing. Zero. And then what do? I have to do my line by line addition. Correct? So I'm going to go to the top, work on my line by line addition. So Polestar group of companies consolidated statement of financial position as at 30th September 2013. So small question, don't we need to take 6,000 share capital instead of 12,000 for immediate cash payments? My dear, it's 6,000 but 50 cents shares. So number of shares will be 12,000, my dear. Okay, why are you doing the financial position first and why not the P&L? That's okay. If it's consolidation, you can start off with financial position, not a problem. Okay, no problem there. You'll not have any problem. Okay, fine. In the exam, I have the option of copy paste. I'm going to simply copy paste in the exam. So assets, non-current assets, property, plant and equipment, investments. Property, plant and equipment equals 41,000 plus 21,000. Investments equals 13,500. And then I've got current assets equals 19,000 plus 4,800. But don't forget, we have to leave space. Goodwill on acquisition, investment in associate. There you go. So total assets. There you go. So once you've taken your total assets, you've got equity and liabilities. Below equity and liabilities, you have share capital. You've got consolidated retained earnings, consolidated revaluation reserves, NCI. Okay. And then current liabilities. And then total equity and liabilities. Are we clear? Are we clear? Because we don't have any non-current liabilities. Okay. If you take current liabilities, I have equals 15,000 plus 7,800. I'm not changing anything. I'm not changing anything. Ever since I started consolidation until now, I'm just taking the same set of approach. Lovely. Now, Polestar group of companies consolidated statement of profit or loss for the year ended 30th September 2013. What do you have? Revenue equals 110,000 plus open brackets 66,000 into 6 over 12. Don't forget. Cost of sales equals 88,000 plus open brackets 67,200 into 6 over 12 gives me gross profits. Operating expenses equals 8,500 plus open brackets 4,400 into 6 over 12. Profit before taxes equals minus 3,500 minus 3,500 plus open brackets 1,000 into 6 over 12. Okay, super. And then profit after tax. There you go. So far, are we clear? Everybody, are we clear? Are we clear? Did we get everything right? So far, did we get everything right? Everybody, please respond. Whoever doesn't respond, I'm going to take you out of the group. If you're in, I want you to respond. Okay, super. So there you go. We're here. Working 3, investment cost in this 13,500 is already done. And then they say, right, the fair value of the contingent consideration at the date of acquisition was estimated to be 1.8 million, but at 30th September 2013, in the light of continuing losses, its value was only 1.5 million. Correct? The contingent consideration has not yet been recorded by Polestar. Okay, this 1,800, your contingent consideration is not recorded, so it has to be recorded. To be recorded, so now I'm going to record it. I'm going to record 1,800, so I go to investment cost plus 1,800. I have a liability to pay 1,800. Done. But they say, in the light of continuing losses, its value was estimated to be only 1.5 million. Okay, you had to pay 1.8 million, but now you're going to pay only 1.5 million. So if you're going to pay less, for you, is it a gain or a loss? Is it a gain or a loss? If you're going to pay less, it's going to be a gain or a loss. Gain of 300 for the parent. Gain of 300 for the parent. Okay. So basically a gain, in other words, a reduction in liability. My liability is going to come down as well. So I come here, my retained earnings, deferred payment, gain of 300. I go to the top, current liabilities comes down by 300. Are we clear so far? Are we clear so far? Fine. My expenses, my operating expenses comes down by 300. Okay, fine. So technically, I have accounted for the deferred income and I have also accounted for the gain in deferred income. Going back, at the date of acquisition, the fair values of South Star's assets were equal to their carrying amounts, with the exception of a property. This had a fair value of 2 million above its carrying amount. Right there, stop. What is it? What is it? Revaluation. So working number 4, revaluation at acquisition. Always remember at acquisition. How much is the revaluation? They say 2,000 gain property, plant and equipment assets. So you go to your revaluation gain account, goes up by 2,000. Your property, plant and equipment also goes up by 2,000. Done. And a remaining useful life of 10 years at that time. Depreciation is included in cost of sales. Okay. Not only that, they also say that this revaluation working 5 has depreciation. Working 5 has depreciation. So your depreciation, they say, is going to be 10 years at the date of acquisition. Therefore, equals 2,000 over 10. But how long since acquisition? Into 6 over 1,200 depreciation. So basically, I go to the top, depreciation equals minus 100. I go to property, plant and equipment, minus 100. I go to cost of sales because they want me to include it as a part of cost of sales, plus 100. Okay, super. So can you please explain contingent consideration again? Okay, contingent consideration. I had to pay 1,800, but I'm gonna pay 1,500. Meaning I'm paying 300 less. If I'm paying 300 less, my liability is going to come down. A reduction in liability is a gain. So gain, I added it to retained earnings. I reduced my liability and I deducted from my expenses. Okay, super. Working 5 done. Working 6. Polestar transferred raw materials at their cost of 4 million to Southstar in June 2013. So Polestar is selling goods to Southstar. When Polestar is selling goods to Southstar, they are selling at 4,000 intergroup transaction. Southstar process all these items. Southstar process all these items materials incurring an additional direct cost of 1.4 million. Okay, there's a processing cost of 1.4 million. Keep that in mind. And sold them back to Polestar in August 2013 for 9 million. So what happens is parent is selling to subsidiary. Once again, subsidiary is selling to the parent. Now subsidiary is selling to the parent for how much? 9,000. Therefore, in total, intragroup sales is going to be 13,000. Are we clear? Super. At 30th September 2013, Polestar had 1.5 million of these goods still in inventory. There were no intercompany, no other intercompany trades, sales. In other words, working number 7, URP. Okay. Before coming to URP, intergroup sales should be eliminated because there have been transaction within the parent and subsidiary. Okay. So how much should I eliminate? 13,000. I go to the top. From revenue, minus 13,000. From cost of sales, minus 13,000. Done. Now what I have to do is I have to calculate the URP. Now for me to calculate the URP, you need to understand something. Okay. Polestar sells goods to Southstar for 4,000. But this goes through a process. There is a processing cost of 1,400. Correct. Therefore, if you try to get the profit element would be 9,000 minus total cost 5,400. So 9,000 minus 5,400 over 9,000 will give you your total profit margin. In other words, equals 9,000 minus 5,400 over 9,000. As a percentage, if you take 40% is going to be your profit margin. Therefore, the goods that you have with you, remaining goods is 1,500 according to the question. So 1,500 into 40% will be your URP. So technically, who is selling? At last, Southstar is selling to the parent. Therefore, eliminated from subsidiaries profits and group inventory. So I'm going to go to the top, retained earnings. Here, URP equals minus 600. I go to current assets from inventory minus 600. Okay. Now I need to eliminate it from cost of sales to cost of sales. I add 600. Are we clear? Are we clear, everybody? Okay, super. Polestar's policy is to value the ACCA interest at fair value at the date of acquisition. This was deemed to be 3.6 million. Why have they given that to us? Why have they given that to us? Why is that given? Super. They have given this 3.6 million to calculate NCI goodwill. All items in the above statement of P&L are deemed to accrue evenly over the year unless otherwise indicated. That is to do the time apportionment. All right. So we're done with the notes. Once we're done with the notes, we don't go back to the notes again. Now we start working on our normal workings. Are we clear? Shall we? Shall we do our normal workings? What's next after this? We're going to work on working number 8. Goodwill on acquisition. For goodwill, what do I require? Investment cost. Immediate cash payment and deferred payment. Immediate cash payment 13,500. Deferred payment 1,800. Therefore, my total parents' investment cost was 15,300. From this, minus acquired net assets. What do I require? Share capital. How much is share capital? Share capital will be 6,000 over here. 6,000. And then I've got retained earnings. Okay. Retained earnings at acquisition. How much is the retained earnings at acquisition? How much is the retained earnings at acquisition? Anybody? Retained earnings at acquisition? $14,300, 9,700, 14,300. How much is retained earnings at acquisition? Anybody? Here what you have is 12,000 as at the balance sheet date. So retained earnings 12,000 as at the balance sheet date, but you want retained earnings at acquisition, that is 6 months before. So if you have to go back 6 months, you have made a loss. Loss of 4,600. This has to be time apportioned. Time apportioned profits. So basically 4,600 is going to be for 1 year. So equals 4,600 into 6 over 12, 2,300. Since it's a loss, my retained earnings at acquisition would have been a higher, larger figure. So if it is a profit, you would have deducted it, Amna. Since it's a loss, I'm gonna add it. Any adjustments to my goodwill? Yeah, there you go. There is revaluation of 2,000 which needs to be added. Revaluation of 2,000. Revaluation gain of 2,000 which needs to be added. So can you please explain this again? Retained earnings. Today, here, right now, you have 12,000, but you require at acquisition. If you want at acquisition, now you're going to go back 6 months. So 6 months, if you go back, you're making a loss. So if you're making a loss, your retained earnings value would have come down. So technically, you need to add back the 6 months profit. Right, lovely. Apart from that, at acquisition, I don't see anything that we need to worry about. So we've taken everything. So total equals sum 22,300 into 75% equals this into 75% gives me 16,725. 15,300 minus 16,725. 1,425. They said we are going to get it as negative goodwill. And there you go. As mentioned, we are getting 1,425 as negative goodwill. Okay, everybody keep your pens down and listen to me. 1,425 negative goodwill. In other words, I can call it a bargain purchase, a negative goodwill, or a capital discount. If it is a negative figure, what have you done? What have you done? Is it a gain for you or is it a loss for you? You paid less, correct. So is it a gain for you or is it a loss for you? Everybody listen to me. The value is 100,000. You're paying less to buy. If you're paying less to buy, this phone is 100,000. If you're purchasing for 80,000, is it a gain or a loss for you? It's a gain. It's a gain. It's a gain, everybody. Please, 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 please get it right. It's a gain. Please get it right. Do you understand? It's a gain. You're purchasing at a lower price. Okay. In this case, it's a gain. Listen to me. I'm going to teach you the accounting treatment. Listen to me. It's a gain. Therefore, added to parents' retained earnings. It's a gain, so you add to parents' retained earnings. Meaning you will not show a goodwill figure because it's a negative figure. We can't have a negative figure in the financial statements. You're not going to show a negative figure. So therefore, what you're going to do is you're going to add it to parents' retained earnings. How do you add it? Look here. I come to the top. Bargain purchase 1,425. I add it. Plus, I come to my P&L. My operating expenses will come down by 1,425. 8,975. Right. Now, did you all understand that? Yes or no? Did you all understand that? Yes or no? Don't worry, I'll come to NCI goodwill. Wait. I'll come there. First, this part of it. Did you understand? Yeah, understood. Okay, super. Now I'm gonna do my NCI goodwill calculation. Okay. So for my NCI goodwill calculation, once again, I require my investment cost. My investment cost for NCI goodwill is how much? How much will be my investment cost for NCI goodwill? Superb, 3,600. I'm going to get my 3,600 here. This time, 25%. 25% on 22,300 into 25% gives me 5575. Oh my God, what happens is 3,600 minus 5575. I have a negative NCI goodwill as well. My NCI goodwill is also negative. Okay. If I have a positive NCI goodwill, I will add to my NCI, correct? If I have a positive NCI goodwill, I will add to my NCI share of net assets, correct? If I have a negative, if I have a negative, deduct from NCI share of net assets. Deduct from NCI share of net assets. That is my next working, NCI share of net assets. I will deduct from that. If my NCI is coming down, inverse relationship, my parents' share of net asset goes up. If my NCI comes down, my parents' share of net asset goes up. Therefore, add to parents' retained earnings. Okay. So technically, there will be no goodwill. The adjustment is made. The adjustment is made to the retained earnings. Clear? Therefore, add to parents' retained earnings. I'm going to go to the top. Parents' retained earnings once again. NCI negative goodwill 1,975 will be added here. I go to the top. My operating expenses will come even further down 1,975, making this 7,000. There you go. What's my next working? What's my next working? What's my next working? Everybody? Everybody with me? There you go. NCI share of net assets, working number 9. NCI share of net assets. I need share capital. Share capital will be 6,000. So I'm going to get my 6,000 put off there. And then I've got retained earnings. At this point, I come to the top. I get my total retained earnings. There you go. 32,200, 11,300, 0, 2,000. So I count to the bottom equals 11,300. And then I have revaluation 2,000. Therefore, total 19,300 into 25%. So equals this into 25%, 4825. And then NCI goodwill, this time it's going to be a negative goodwill. Therefore, total 3,400 NCI share of net assets. So it's not 1,425, it's 1,975. Oh, okay. I think I got the wrong figure from here. It's 1,975 to 850. Okay, now okay. Now okay. If it's positive, I will add. Since it's negative, I'm deducting. My NCI share of net assets done. Working 10. Consolidated. Retained earnings in the exam, it will be my balancing figure, but that's okay. Here, I'm gonna work around. Parent consolidated retained earnings has 32,200. Subsidiary today and at acquisition. Today, you can get it from NCI. At acquisition, you can get it from goodwill. Therefore, equals this minus this equals this into 75%, 2,250. Therefore, total 29,950. And finally, I've got consolidated revaluation reserves. I've told you if my revaluation at acquisition and reporting date is the same, don't do consolidated revaluation reserve. It's 2000 here, it's 2000 here. So please don't do consolidated revaluation reserve. It's going to be 0. Are we clear? Shall we balance? Shall we balance? Okay, superb. Let's go to the top. So my goodwill is going to be 0. My investment cost I've completely taken, so minus 15,300 becomes 0. No investments in associate, 0. Therefore, my total non-current assets will be 63,900. My total current assets is 23,200. Therefore, my total assets will be 87,100. Number 1. My share capital, oh, I forgot, it has to be always parents. We should have taken it earlier. Consolidated retained earnings, we already calculated it, 29,950. NCI, we already calculated it, 2,850. Therefore, my total will be 62,000. Oh no, this is 0, but this is 2,850. Therefore, my total is going to be 62,800. Total equity. And then I've got my current liabilities done, total equity and liabilities, 87,100, 87,100, it is balancing. Are we clear? Are we clear? We can also finish off our P&L equals 130,000 minus 109,300, 2,700 equals this minus 7,000, 13,700 equals sum 10,700. Finally, I have NCI share of profits to calculate. My NCI share of profits will be subsidiaries profits, to which I will take all the adjustments. Subsidiaries profit is going to be 4,600 but negative. So equals minus 4,600, but I require it for 6 months into 6 over 12, 2,300. Well, what are the adjustments that I made? What are the adjustments that we made? There you go. We can get all our adjustments from here. Here, depreciation and URP. So depreciation was 100, URP was 600. 600. Therefore, total 3,000, but 25% belongs to NCI into 25%, 750. So there you go. NCI share of profit is going to be 750. I think we did this question way more quicker than any other questions that we've done earlier. Are we clear, boys? Are we clear? Sir, time for prayer break. Okay, I'm done. Okay. Anyway, I'm sharing this with you. I've already shared it with you. But everybody, did you understand the question? Did you understand the question? Everybody, did you understand the question? Are we clear? Are we clear? Please practice this again on your own. Please practice this again on your own. And if you have any doubts, let me know. This Monday, I want to meet you again. This Monday, I want to meet you again. So if we have time, can we do Pricewell? Pricewell, I've already done it with you. I remember doing it with you, Pricewell. Guys, I did this question Pricewell with you already, right? I remember doing it with you. Okay. Well, okay, no problem. If that's the case, we can do it on Monday. And I want to meet you again on Monday. Okay, if you want me to do Pricewell, it's fine. For any doubts, any questions, we can meet again on Monday. And this particular class has both Indian students and Sri Lankan students. Indian students, you would have already got your mock. Sri Lankan students, you want the mock for tomorrow, yeah? Sri Lankan students, tomorrow, some of you messaged me asking for Monday. I can arrange it for tomorrow. I will communicate to you in the group. Please respond. But Indian students, it's available. I was told that it's available, but let me check and get back to you. I'll respond in the group. So guys, once again on the group, let's respond. Please message when I drop you a message, and we will meet on Monday. But before that, we will work on the mocks as well, whatever we have. Thank you, everyone. Bye bye. Take care. I'll see you on Monday, but I'll message on the group regarding the mock. Take care, boys. Bye bye.